My name is David Jaffee. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com.
The Crash Protocol: How to Catch the Market Bottom. A tactical playbook for experienced traders to transform market chaos into explosive opportunity. When fear spikes, fortunes are made. The Psychology Trap: Why most people lose. Market drops 20%. Volatility is measured by the VIX spikes. Panic spreads across trading floors. Number 2, fear takes over. Emotion overrides strategy. Discipline evaporates. Number 3, most people in that situation end up selling at the bottom. Investors capitulate at maximum pain, locking in losses, only to then see the very positions that they sold at the very bottom rebound and then frequently hit new highs. 4, as mentioned, miss the recovery. The V-shaped bottom happens fast. If you blink, and you're out. Step 1, survival mode. Stop the bleeding. Stop buying. When the drop starts, preserve capital immediately. No new positions, no exceptions. No call debit spreads. Directional plays will get crushed. Avoid any bullish strategies during the initial decline. The only caveat to this is I do like to use 1 DTE trades using SPX or XSP when VIX spikes up to about 25 or 30, and I sell very far out of the money. Roll out your puts. Extend duration on threatened short puts to avoid assignment at unfavorable prices. Buy time, preserve capital. Critical: your first priority is defense. Don't try to be a hero. Your primary goal is to survive the initial shockwave. Step 2, the rebound signal. Confirm before entry. Day 1, green close. First bounce appears, stay patient. Day 2, green close. Pattern developing, then prepare your capital. Day 3, if there's a green close there as well, that's a confirmation signal. Now it's time to deploy capital and start making bullish investments. Do not try to catch a falling knife. Wait for 2 to 3 consecutive green days. Confirmation beats speculation every time. Capital deployment: the war chest unlock. Remember SGOV and box, which is where we store a lot of our capital during good times when the market is euphoric and when VIX is trading at about 15. This is your cash equivalent positions. These positions you can now liquidate to free up capital and deploy it in directional and bullish investments. Now it's time for offense. As mentioned, you can liquidate it, convert your safe haven positions to cash immediately. Cash is king. During a crash, liquidity is your ultimate weapon for capturing opportunity. High risk, high reward. The TQQ Turbo Strategy. Allocate 10 to 20% of cash. This is aggressive capital. Only use what you can afford to lose. Keep the majority in reserve for forced assignment. You can buy TQQ call options. Target 3x leveraged NASDAQ ETF for maximum upside exposure. This amplifies gains during V-shaped recoveries. Expiration 1 year out. You can use leaps. Long-dated options reduce time decay risk and give the recovery room to develop fully. Critical warning: the TQQ rules. What not to do. Never sell puts on TQQ during a crash. Volatility expansion will annihilate your margin. The 3x leverage works against you on put selling. Assignment at catastrophic levels is almost guaranteed. Well, I don't know if it's really guaranteed, but You definitely don't want to sell puts on TQQ, especially when volatility is expanding. Only buy calls on TQQ. Define risk. Purchasing calls limits your downside to the premium you paid. You control the risk. There's no margin calls, no forced liquidations, no sleepless nights. Remember, TQQ magnifies everything. In a crash, selling premium on leveraged ETFs is suicide. Stay on the buy side only. Step 3. Force assignment. Own the bottom. The tactical move. Take your short puts on quality names like Nvidia or Microsoft or Meta and roll them in the money. This forces your broker to assign you shares at depressed prices. You're essentially commanding, give me the stock now at these fire sale levels. Now again, there's a major caveat here. You only want to do this after the market has gone up 3 straight days and volatility has already contracted. You don't want to force assignment of shares only to then see the market continue to fall and volatility to continue to increase. Identify the short puts, target positions on blue chip tech stocks. You can roll those options to be in the money, move strikes above the current market price, then force assignment, get shares at the bottom, or at least we hope it's the bottom, because as they say, they don't ring the bell at the bottom. Why we force assignment? Options have time decay. Theta erodes value daily. Even if you're right about direction, time works against you constantly. Stock ownership eliminates time decay completely. You can hold forever without value erosion from time. Ride the recovery stress-free. No expiration dates to worry about, no Greeks to manage, just pure equity exposure to capture the V-shaped rebound. This is how you catch the V-shape. Convert leveraged short options into unleveraged long equity at the moment of maximum fear. Now, moment of maximum fear, we don't know when that is. But basically, when VIX is trading over 30, and you've also waited for confirmation that the crash has ended after 3 straight up days, then in general, that's a very good determination that now is the time to take assignment. And also to go long, you can use the TQQ call strategy that we discussed earlier. The stock replacement alternative. Can't afford full share assignment? Buy 80 delta deep in the money leaps. Select calls far in the money with high delta for stock-like behavior. This acts like stock ownership. It moves almost 1-for-1 with the underlying stock, capturing the same recovery. It also uses less capital. You can control 100 shares with a fraction of the cost, freeing capital for other opportunities. Deep in the money leaps give you leverage without the volatility crush of out of the money options. Think of them as stock on margin with defined risk. If you have any questions, you can leave a comment below. You can also visit beststockstrategy.com, enter in your email address, and receive over $400 of valuable free training. Please like and subscribe, and also comment on this video if you have any questions.
Visit beststockstrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and review. If you have any questions, visit beststockstrategy.com and send me a message.